Fortune Brands, the maker of Jim Beam bourbon and also Titleist golf balls, plans to split into 3 separate businesses and focus on the distilled spirits part of it. We learned that earlier this week. We're joined now by Gamco Investors Chairman and founder and CEO Mary Gabelli, who has 2.2 million shares of Fortune Brands, and also John as well, who's been reporting on this story for us throughout. And Mario, I know you're somewhat jet-lagged, right? A tour around the world. You talked with Fortune Brands yesterday. They were going around talking to their investors about this breakup. What did you get out of them?
Well, nothing new, but just fine-tuned some of the dynamics with regards to the process of the split-up, Betty. 1911, 100 years ago, this company was created, an antitrust suit. They've done a lot of financial engineering, but what they're doing is part of financial engineering, whether it's merger and acquisitions or real allocation of capital. These distilled spirits, better known as booze to some of us, is a $150 billion industry worldwide, and bourbon is a small subset of that. The wine industry is $225 billion. So the notion of consolidation of the spirits business is intriguing. Diageo, Pernod, Brown-Forman is having an analyst meeting today, and obviously Fortune Brands are part of that process. So right. The split up is all part of that.
What would be your take, Mary? I know that, obviously Diageo would love to maybe do some type of deal, but you said antitrust. I mean, is there a competitive threat of getting something?
I wouldn't look at it that way. The analysts that follow this industry traditionally have looked at a multiple of EBITDA, which is fine, but they have to look at the gross profit in the brand category and look at the multiple of companies are willing to pay for that, so you get a much higher valuation. As a standalone company, the distilled spirits business is going to be awfully attractive to a lot of participants. But don't ignore the fact that I think they'll do $800 million of EBITDA a couple of years out if you put a 16 multiple, not the 11 that most traditional analysts look at, or maybe even a higher valuation. It's a unique asset. That doesn't mean it's someone's going to buy it, but that's what the private market value would be and how it would trade in the public markets, Betty. So the second part, and don't ignore the second part, is they have $3.6 billion of debt. They can sell off the golf business very tax efficiently, reduce the debt, allocated it to its various components. And so you have a pretty interesting split up. 2 companies that I like, not only one.
Okay.
Oh, we just showed that stock price. It's had this huge move since Erlichman made his announcement.
Well, come on, it's up 30%. The stock is still 20% lower than it was 3 or 4 years ago when housing collapsed.
So you don't sell your stake because
forget it. Erlichman is great. He basically got in front of a big wave. The big wave is mergers and acquisitions, and in addition to that, rearrangement of corporate assets. But Bruce Cabinari and his team were ready to do something. They can't just do it like that. They've done a lot of work on it.
The Lex.
But I like Bill. Thank you, Bill.
Yes,
he
did a lot of work.
I got some more for you, Bill, that I want you to get in front of.
Just quickly, Mario, because the Lex column in the FT had a pretty good breakdown of what the parts of Fortune Brands are worth. I think they said something like the furnishings and also the golf part of it worth about $4 billion. So that's why I ask you, what do you think the value is of the liquor business?
The answer is different because everyone looks at their mosaic. We gathered the data, array the data, project it and interpret our way. We think you can have a $90 to $100 stock if they left it alone 3 or 4 years out. So 50% in 3 years is 15% a year. That's not bad. It's what we call a very good rate of return. So that's why we like it. And there's a great deal of fortune to be made yet in that company.
Is this serving the shareholders right for Carlyle or any of these PE firms to go public?
Well, I think what he was talking about is the money that he's raised from the endowments and all of those others that have entrusted assets to him. Can he earn and allocate that capital efficiently over the next 10 years? And I think there's a world for private equity, and they have done an interesting dynamic in the process of that. And then taking the company public. Well, you saw Schwartzman do it. You saw Kravis do it. Why not?
They haven't done very well, though, the stocks themselves.
Well, Henry went public indirectly through merging with one of the vehicles that he created, and the stock has done quite well. Schwartzman has not.
But Schwartzman, I would say no.
Yeah, I mean,
the stock was 30 and it's now 14 or whatever it is it?
Yeah, it's interesting when you talk about that vehicle that KKR merged with the European entity that KKR merged with the vehicle that eventually went public. If you look at what they actually went public with on Amsterdam, it's actually down quite a bit. They went out at $25 a share. We wouldn't compare it. Yeah, we wouldn't compare it to what they're trading at in New York. You're absolutely right. The stock has gone up since it's gone public in New York, since it's been trading in New York.
Right.
But I guess the conflict of interest that he was Conway, that I was referring to with Conway, is this idea that, you know, if you really look what's in the best interest of the limited partners, it's actually to keep management fees as low as possible and make sure that you earn most of your money off of what's called carried interest, which is the portion of the profits that the GP gets. Public investors really want to see higher management fees because that's how the street values these stocks.
Right.
Because the management fees are way more consistent and the carry is much more lumpy.
Right.
So,
you mentioned that before, that it's a difficulty in valuing these companies because of that very structure.
Oh, I don't think so. I mean, it's basically, we buy money managers. We earn a fee of 1%. And are we better off having a lumpy 20% compound growth rate over the next 20 years or a 12% steady stream? And that's what we figure out every day. And so we'll put a valuation on it. And I like 20% lumpy.
Well, that's great. I mean,
the answer is, can you do 20% CAGRs? And I don't know the answer to that.
No, just having spoken with analysts, it's very hard for them to model it. They don't know when that 20%, profit is coming. So from the street's perspective, I think it's just going to take them a little bit more time to kind of learn how these companies operate.
That's why they make $200,000 and the other guy makes $20 million.
The tax situation and what that is doing to the markets right now.
Well, I think the proposal on the table, that is a compromise between the White House and Congress, is a very sound dynamic. It has an impact of lifting the economy because of the payback to the worker of a portion of the money that the government was taking. But the other part is he proposed 100% write-off of capital expenditures. That's very good for investment.
Right.
In addition to that, the predictability of your tax structure is very good. That's important. And that gives us confidence to do planning.
Right, but why aren't we seeing that reflected more in the equity markets then?
Well, the equity markets have anticipated this in part after the election, which was 4 weeks ago. In addition to that, Betty, and I have to echo this, the United States has to become more competitive. Dropping corporate rates to compete around the world is the way to create jobs. This is a job creation program. And secondly, it's a Make America Competitive program. And third, it's put America back into the seat of power, and at the seat of power on a global basis by getting the house in order. Well, I think the notion of going to the business sector and saying to them, start your engines because clarity is here. That is the message of this package in its entirety. And secondly, the world will come back and look at the United States and say, okay, you are going to provide economic leadership. And that gives us a more powerful setting with regards to establish political priorities on a global basis. So I have to be totally in favor. Now, from my point of view, you got to raise taxes at some point because you need money and you got to reduce the deficit.
Are you hearing from, you talk to CEOs all the time, are you hearing that they're saying, yes, I'm going to start hiring people? Because we know the profit power and the lift behind stocks is in part because they've been holding on to their cash and not hiring people. Are they saying to you now, yes, actually, we are going to start doing
I think you got two disconnects. And the most important one is, will we make money? And will we have liquidity? And will we have clarity? And will we not be bashed as business individuals? And should we locate jobs in America? And lowering corporate taxes in the United States is an important part of that process. And so...
And closing the loopholes.
Absolutely close the loopholes. Some of them, for example, hedge funds getting carried interest for the profits. There's so many obvious ones that can be fixed. Spraying oil on top of coal to get a synthetic fuel. The point is, stop bashing business, start praising business, start creating jobs, create the guys like Groupon, a 30-year-old that can come up and create a new business in the digital world, unleash American power, and get rid of the handcuffs of regulation that have been imposed like Sarbanes-Oxley and capital creation.
But then what do you make then, Mario, of what we've seen in the bond markets these last 2 days in reaction to this tax package?
It was terrific. The bond market's doing what it was doing, and that is, was it consistent to have a 2.5 on a 10? No. Was it consistent at 320? It's finding its equilibrium. The key question for equity holders, at what point does the rise in the bond market at the 10-year have an impact on the economy? What impact will oil have at $90? The stock market has valued in, I think, a 4 to 4.5% 10-year in terms of multiple.
4 and 4.5. Okay.
Yeah.
We talk about the bond vigilantes. You're in the mutual fund business. I think inflows into equities.
I'm in the money management business. I'm a risk-adjusted return business.
But my point being, inflows into equity funds here in the U.S. over the last 16 months. I think we've only seen positive, that number positive like 3 times.
Yes.
Well, that's terrific, because that means everybody bought fixed income over the last 10 years, and fixed income has high risk, as you just saw in the last 2 weeks.
And they're all going to flow into equities.
We don't know. But the answer is we don't care. We're looking at one company at a time from our point of view, and I'm not taking the big picture. I just think about what I do for my clients. Can I find a Thomas & Betts that's selling at $48 with a good management, selling at a cheap price, that could be sold at $100 in 3 years? And the answer is more often than not.
Mario, always a pleasure to have you with us. Great to see you.
Always a privilege to be here. Thank you for having me, and delighted to talk about stocks.
Yes, Mario Gabelli of Gamco.